I'm just going to get us right into this, give us a little bit of an intro, and then go into it. If you guys can see in the top left, the space is recorded. We got someone from the Bullish team down below recording it as well, so we could throw it up on YouTube. But I'm just going to get right into it now. We got about 130 people. We didn't even get the tweet out, but maybe we should be, but whatever. So yeah, I appreciate everyone joining in for this spaces. This is specifically for long-term investors. We are trying to make this space go every single week. So we're going to play around with what we do and what we present. A lot of today is going to be first, we're going to get a good deep dive into a company, trying to get some good lessons on what do experienced long-term investors look for when they're doing their due diligence, what are the type of terms they use, how do they, what are the biggest numbers they focus toward, that type of thing. We're going to have Alex take us through Microsoft's, their earnings, and a little bit of a deep dive into the company, help you guys realize, when a company comes out and you have to go through their earnings call, what are the type of things you look for? What are the type of numbers in there? What stands out? How do you, compare to other quarters, and how do you kind of rationalize a move in the stock price? And then moving on to Stock Talk Weekly is going to come in and, help us talk about how long-term investors can capitalize on market volatility, which has been a really big, recent case, keyword, whatever it is, but that's the type of market we have been in recently. So I'm super excited for that. The spaces will be every single Thursday at noon, focused on long-term investing. It feels like all the Twitter spaces right now are technical analysis and traders and whatever, and that is fantastic. It's easy to talk about that each day, but we want something in here for all of you long-term investors out there who can kind of get this knowledge and hopefully help you out. So with that, I'm going to stop the blabbering. Wolf, I see you got your hand up.
Yeah, I just went ahead and put out that tweet. So there should be a tweet out from the Bullish Rippers account. We tagged all of our speakers. If y'all could share that, that would be very helpful. We can go ahead and get your audiences in here. Also, Evan, it kind of fucked up something on my end when I went into the other account while on this. So I'm going to leave real quick, but I'll be right back.
No worries, dude. I appreciate you getting that tweet out. Sent over that co-host. But yeah, I think that's enough blabbering from me. I would love to hop right into it and start it with and throw it over to Alex. Yeah, Alex, would love to hear your thoughts on Microsoft, their earnings, whatever you got from that. And yeah, whatever you think could be helpful and educational to our crowd of long-term investors. Actually, sorry, I want to take a step back as well. Can you also introduce yourself a little bit? This is the first time on the spaces. I've heard some really good stuff from Brad, but yeah, I would love to kind of first get that and then get your thoughts on Microsoft, if that's possible.
Sure, and jump back in and ask me again if I skip something that's important. Quick introduction to me. My name's Alex Morris. I run the TSOH Investment Research Service through Substack. Essentially, it's deep dive equity research on the companies that I own, the companies that I follow, the new companies I'm trying to get my arms around. I throw in a little bit of investment philosophy type discussions in there, stuff like asset allocation, holding cash, thoughts on things like never sell, et cetera. So I basically talk about whatever's interesting to me at the time or what I think is important to think about as a long-term investor. So you can find the link at obviously on my Twitter handle. As it relates to Microsoft and thinking about a quarter, I should probably take a step back and say, I've owned Microsoft for over a decade now, so that perspective of having followed the company for such a long time really paints how I think about what's important as I pull up, a press release or a slide deck to see what the company is talking about and what they're focusing on. And I don't really look at things like, hey, here was the revenue number relative to analyst expectations or the EPS number, whatever it may be. I don't really find a lot of value in those things. And there's plenty of times, and Microsoft's an example where, falling short on EPS potentially can be a very good thing. As I spoke about a few quarters ago, they were ramping OpEx pretty aggressively because they saw so many opportunities to invest in the business. And obviously that would presumably show up in the financials over the long term. So I think it's super important to get to a place where you're partnered with management teams and companies that you truly trust, and you can pull up a press release or listen to a call and have a lot of confidence that they're being transparent and honest with you. For me, that's been invaluable, and it's something I've really learned to appreciate with companies like Microsoft. The numbers that I focus on more than kind of the top line revenue or an earnings number or EPS number would be the KPIs that I think are most important for the business. And obviously that varies depending on the company or industry, but in the case of Microsoft, it's things like the cloud business and seeing how the growth rate there has changed over time, which naturally it slows a little bit as they get bigger and bigger, but it's been a massive success so far. It's also KPIs for individual businesses, whether it's gaming or LinkedIn or whatever it may be. So I have numbers that I'm tracking over the course of quarters or years, and even how a management team thinks about those KPIs and how they potentially change them over time is also very revealing. So that's at a high level how I kind of approach it, but I'm happy to talk about anything in specifics if you'd like.
No, definitely. I would love to hear some of those key numbers that you kind of do take in from Microsoft specifically, and kind of also, Microsoft's move. The stock price. What really happened yesterday with earnings is it dipped when that initial number came out. The numbers were really strong, but there was no forward guidance, and we waited until we got the forward guidance, which ended up being solid on the conference call, and the stock started to move up higher after that. So kind of actually, there's going to be two questions in here. How important is the earnings call for you kind of in making up your decisions? And how do you kind of deal with stock price moves and kind of evaluating like, okay, I thought this quarter was really good, but the stock is down whatever percentage. Just kind of dealing with that as well. I know there was a couple questions in there, so I could come back with one at a time.
Yeah, the stuff on guidance is it's always just company specific, right? I mean, Microsoft is a company where you don't get any guidance until they get to the later portion of the call, and then Amy Hood will kind of give you some numbers, but you don't get anything in the press release, basically. You have other companies that I own, like Dollar General, where, the range of what they expect on a few KPIs will, inevitably tighten as the year goes on. And then obviously I own other companies like Berkshire, where there is no quarterly calls, there is no guidance. I kind of prefer the third one, to be honest. I like the idea that management is not sitting there wasting their time worried about, tightening an EPS range by a dime or something like that. I just view it truly as a waste of time and a misguided exercise. Essentially, it has merit, but it can lead to misfocus within the organization. So that's kind of how I think about that. In terms of the stock reaction, I think it's a balance. I think when you first start investing, or at least as I came into investing from the value investor mindset and market inefficiency, et cetera, I think you can be a little bit too disrespectful of the market, I guess you could say. And the idea that a stock trades off 5 or 10% on earnings, you can just say, well, this is short-term noise, and I'm a long-term investor, and I'm going to use it as an opportunity to buy. I think you do need to give the market some respect, and you need to balance that with the conviction that you have in the business. So I basically do what I can to completely disregard what the market's saying about the quarter, whether or not the stock's up 5%, down 5%. I just step back and again focus on the metrics and the KPIs that I think are truly indicative of where the business is heading over the long term. So, when I pull up Twitter after Microsoft reports and I see people talking about how it's trading down 5% and then it's up 5%, and I really just think that's all noise, and I do what I can to just completely disregard it.
Definitely agree. I love that thought and concept. I'm definitely going to come to you with one more question. We'll keep it flowing after, and then definitely would love to kind of get you the opportunity to chime in when we're in there a little bit later talking to the other speakers. But, a lot of investors, a lot of long-term investors really come in and ask, where do I start? How do I start investing? Or whatever. My two answers are generally ETFs is a good place to start, and then start at these mega cap stocks where you can kind of do the research into the companies and really see what a good company looks like, what a good earnings looks like, and kind of gives you a base to compare everything else to when you look further. So how do you kind of like see the comparison of Microsoft's earnings compared to some of these other smaller stocks that you see? Obviously, Microsoft is the behemoth that it is, and they're going to have really great earnings, or else it wouldn't be a $2 trillion plus company or whatever it is at now. What are some of like the key difference that you notice just about like quality or whatever it is on a Microsoft earnings compared to some of these other smaller companies? Is there anything specific?
Yeah, kind of to your first point, like how do you even start doing this? A company like Microsoft's really hard just because it's so big and there's so many different things happening. I mean, a lot of them are the same trend, but there's so many different things happening that it can be really hard to get your arms around it and understand it, I think. I tell people who, not if they're just investing for the first time, but if they really want to start doing research on their own and trying to think through these things, I personally think it's really a great place to start is with a retail business, something like, let's say like a Dollar General, something like that, where as you look at the business, you can really appreciate what their strategy is at a high level. And then as you dig into the numbers, it's not hard to understand something like, the company investing, let's say $1 million in a new box and then generating a couple 100,000 in EBIT. I think as you think through that, you can understand the unit economics in a way that is just very straightforward. It's the same as the idea of you opening up a convenience store on the corner or something. You know what I mean? It's something you can wrap your head around much more easily than trying to get your arms around the behemoth that is, a company like Microsoft. So I think that's really where I think people should start, is just to understand a business that's very straightforward and something they can really get their arms around. What was the second question? I'm sorry.
I actually think that was a pretty good coverage on the question, kind of how you start out, what are decent places. But I guess the kind of second part of the question is like, when you look at Microsoft, obviously there's a lot going on, but you don't get valued at $2 trillion unless you have good earnings reports, good whatever going on. It's like, I know this might be a difficult question. What is something you notice with those type of mega cap companies on their earnings or whatever it is compared to some of those other, smaller companies that might not have it? Is it, just like the trust that management has, and you kind of said at the start that, what they're saying on there, they're putting a lot of opinions, putting a lot of what they think is going to happen, but they've given you that faith in the past that they're going to actually act on that? Or is there anything like specific that you kind of see in the numbers or like trends or whatever with those really, really quality mega cap names?
I got you. Okay. Yeah, I think partly to this idea is what Warren Buffett has said previously about this idea of, you can't have a rock concert one night and then have the ballet the next night. People are not going to know what to expect. It's these certain management teams. And what really made me appreciate this idea even more is the HBO book that came out recently and talked about Warner Media and how, through the, call it 2010s period, they effectively got to a place where they had a shareholder base where in management's view, they would not have the ability to invest or the income statement to go after the D2C video business because their investors wouldn't give them that leash. The stock would take a big hit. And when that happened, they'd get acquired by, they were specifically worried about Murdoch. But, that's a good example of a company that is in a very difficult spot because they haven't built the credibility with their investors to make, needed investments in the business. So I think that's a good example of when you see companies from time to time say something like, this competitor of ours doesn't have to focus on earnings. The market's giving them a leash, and they're kind of saying like it's not fair to us. I've learned to think that that's a huge red flag. Whether or not that company has a viable business model may be up to question, but the fact that they're taking engagement and market share from the customer base is almost certain. So, you're in a very difficult spot if you're Warner Media in that example. So I think we need to really look for management teams that over a long period of time have clearly communicated what their vision is and they've shown an ability to execute against that vision over time. So I focus on things like, I'll read quarterly calls going back a couple of years. I'll read shareholder letters when they're available. When I find things in there that stand out to me as red flags, that's a hugely important part of my research process. So it's, a lot of the things that I do are really more qualitative than quantitative, and that's a key one right there.
Well, you actually did bring up a good point that I did want to ask a little bit more there. So when you are doing the due diligence into these earnings, you mentioned that sometimes you kind of go back to the couple ones, a year, 2 years, whatever the earnings call is from the past, and kind of look at it for those type of things that they were saying to see if they actually hit on them, but also kind of the numbers. I find it really, a lot of people get caught up in just this one specific number, but the trend over the last couple earnings is what's much more important. So when you're doing this research, do you actually go back and look at past earnings call a lot of times? How many past earnings call, like if you're looking at a stock for right now, are you going to go back the past 2 years of conference earnings calls or whatever it is, 10Ks? Or is there kind of a strategy with that? And yeah, maybe some more of those important things that you get out from looking from the past.
Yeah, so this is the single most important outside research tool that I use, is something where I can search old transcripts. So how I typically approach this is I almost never listen to conference calls live because I need the ability to pause and think about things and also to look at what companies have said about stuff in the past. So a great example this past quarter is for Netflix there was a lot of discussion about India and Brazil. So when I'm listening to the call, I pause it at that point, and then I go to a tool like BAM-SEC, and I go to Netflix and I search for the word India, and I'll read everything that they've said. And BAM-SEC has conference calls going back 10+ years. It's a really great service. I'll go back and read everything they've said about India for as far back basically as I can, obviously within reason. But many times, you might put a term like that in, and the number of hits that you'll get will be relatively small. It might only be 20 or 30. So I'll go back and read everything they've said over time about a specific topic. And then I just think to myself, how much of this is, consistent thought? Do they seem to be making progress on this? How has this opportunity or threat changed over time? So I think through those type of things. And that's one of the most, for a company that I've followed for a while, that's one of the most valuable things I think that I do as part of the kind of earnings review process.
Perfect. I love that. Awesome. Appreciate all that amazing insight, Alex. Definitely have to get you on one of these again. Hang out. We'll probably be able to come around to get everything back to you a little bit. But yeah, appreciate you so much. Some really fantastic insights there. I think whenever you're doing your due diligence, looking into companies, you don't have to only look at that earnings report. You have to look at the past earnings report. You have to look at competitors. There's a lot of work that goes into long-term investing. It's not a super easy game of just, ooh, I like this stock. You can kind of hear some of the insights there around earnings. One more time, I really appreciate that, Alex. Make sure you're following all the speakers up here. We are only bringing up the best of the best for this long-term investing space. We're really grateful to have Alex, Brad, and Stock Talk in here to give some amazing insights. Shout out to Wolf Financial, Gav, and Joey up here, who do a bunch of spaces as well and show us a lot of support and love and really great content. And a big shout out to the Rippers account hosting these spaces. We're doing this 3 or 4 times a week. We got tweets going out every day. I myself, I run the Stock Market News account that's up here. And so if you guys like my tweets there, you'll love the stuff that comes out here. But with that, I'm going to keep us cycling and throw us over to Brad to get us into a deep dive into one of his stocks.
Yeah, and I think so. Last week I was going to do GoodRx, and then SoFi dropped all that bank charter news, so I switched to that. But so this week I'll do GoodRx, which is a fascinatingly complex company. Really simple from a consumer perspective. You click on a button and get a cheaper price. And I've actually talked to Alex about this name, so it'll be interesting to hear his feedback at the end. But yeah, it under the hood, very complicated. So what we know it as is a pharmacy discount product. So I'm going to run through 3 of the pieces of the supply chain that kind of lead to this issue we all know about of sky high drug prices for a large cohort of Americans. So I'll kind of uncover where those pricing inefficiencies come from, and then how GoodRx is taking advantage of it, and then how it's kind of branching into other ways to provide more value. So party number 1 to consider within this pharmacy value chain and misaligned incentives is the PBM, or the pharmacy benefits manager. So this company, or this type of company, as a lot of you probably know, works on behalf of insurance companies and large employers, and they negotiate pricing concessions with pharmacies. So they really lean on aggregating all of the membership bases that they've signed on to their ecosystems to negotiate lower prices. Pharmacies enjoy more demand, albeit with lower margins, because PBM-sponsored copays are lower than what's called the UNC price, or the usual and customary price, which is also sometimes called the cash price, which is essentially it's just what non-insured and non-represented individuals would pay at the pharmacy counter without any help from a PBM or another company such as GoodRx. So when a PBM fosters a pharmacy sale, it charges the associated insurer, so whoever this member is represented by, what's called the maximum allowable cost. So that's just the term for the highest drug price allowed by the PBM. The PBM, who's essentially just a middleman in a really good place at a really good time, uses these funds and then compensates the pharmacy. But one of the interesting things about this compensation is that they'll pay the pharmacy a lot less than they collected from the insurer. So they pocket what in this industry is called the spread, which is funds collected by a PBM from an insurer minus proceeds paid to the pharmacy for dispensing a drug. So PBMs not only are they charging exorbitant amounts of money above what the actual cost of transaction is for them, but they don't have to disclose any of this publicly in terms of PBM and pharmacy contracts. So there's a lot of it's a black box at this point. I mean, we don't generally associate black boxes with trips to a retail center, but the pharmacy is a pretty special and unique retail center. So a little bit different. The other thing to consider about pharmacies is that they work with PBMs is that they work with drug manufacturers. So drug manufacturers will pay the PBMs to recommend their medications versus a close substitute, and then also to negotiate lower price copays to financially incentivize volume and purchasing. So this is this is an inherent conflict of interest. So PBMs are not encouraging their networks of insured lives to take the best, most timely, most affordable, most effective medication. They are nudging oftentimes their consumers towards whichever drug has a manufacturer attached to it willing to pay the highest kickback fee. So as you kind of know, as a lot of you probably know, within the generic space, there's a lot of substitutes for what we can take to kind of accomplish the same objective, and PBMs really take advantage of this, which kind of pushes not the main contributor to, but pushes that issue of high drug pricing. But I'll get to the main cause in a second. But before I do, important to cover the insurer and why these massive companies with deep pockets are willing to pay PBMs massive spreads when it seems like it would be bad business for them. So interestingly, there's been a lot of vertical integration in the space. A lot of these largest PBM or a lot of these largest insurers or carriers actually own PBMs. And it's a good business decision for them to allow these types of transactions to continue happening, just because PBM businesses are inherently or come with inherently better margins than insurers do. So while they might be cannibalizing top line a little bit, they're doing so while juicing margins. So a net positive for them. So the pharmacy we also have to talk about, and this is really where the issue of sky high drug pricing comes from, but it is not the pharmacy's fault. I want to emphasize that, not the pharmacy's fault. So the minimum that a PBM will ever reimburse a pharmacy for disposing or for dispersal of a drug is this UNC price or this cash price that I talked about earlier. So because of this, the pharmacy almost always sets this cash price far above the estimated reimbursement to ensure that it's not missing out on any revenue. So, for example, if a pharmacy sets a UNC price of $1, but the PBM was willing to pay them $10 for reimbursement, they're compensated that $1 and they leave $9 on the table. If they charge $11 or $12 or $13, they still, or if that's the price they set, they still get this $10 of reimbursement from the PBM. So they really have an incentive to guess higher in terms of cash prices to make sure they're not leaving any money on the table. And what does that lead to? So cash prices, again, this is what the uninsured, the unrepresented are paying. So what this leads to is the most vulnerable cohort of our population footing the bill as a byproduct of these misaligned incentives for drugs and paying absorbent amounts above what they should be paying because of the way PBM and pharmacy relationships exist predominantly. So more problems with healthcare, just really high level. A lot of even the insurers, which this is key for GoodRx because their cohort's not just uninsured lives, but high deductible health plans, so HDHPs. So this is essentially very high cost health plans where insurers aren't stepping in nearly as quickly as they would with a normal one to start covering some of the costs. We now have 30% of insured employees in the United States covered under these plans versus 8% in 2009. So there's been rapid growth in deductibles and copays where we're pushing more and more of the costs onto insured lives. So just keep that idea in mind. And I'm going to move on now because I could talk about this for an hour and I want to hear Stock Talk Weekly speak as well. But how does GoodRx take advantage of, really help consumers within this really crazy value chain? So PBMs also have what's called a cash price business. So this is separate from their relationships with insurers. It's essentially something that they're just allowed to do in order for, or in exchange for having all of this aggregated demand and for being in the driver's seat for a lot of negotiations. So what GoodRx will do is they will take these cash price quotes, and that's actually what they're putting on this website. So these cash price quotes are often in excess of 80% lower than UNC prices. A few years ago, it was 59% lower, then it was 71% lower, then it was 79% lower, and that just ticked up to 80% lower. So just showing you how much positive momentum GoodRx has had in terms of fostering better savings rates, and that's really a product of their scale. So over 20 million monthly active visitors or monthly active consumers, as they like to call them, and then over 12 PBMs in their network. Nobody comes close. I think they actually have around 15 because they've had over 12 for a few quarters, and they've since added a few more. So I think it's safe to say over 15 now, but they haven't updated us since over 12. But all these pricing advantages obviously intuitively lead to GoodRx users being 60% more likely to adhere to prescription schedules, and then 81% of GoodRx consumers affording all their medications versus 23% without it. And the stakes here are extremely high. So according to JAMA, the Journal for American Medical Associations, that someone dies every 4 minutes from not taking a prescription as recommended. So not to get morbid, not to get serious, but that is just a fact, and it's the effect of 20 to 30% of prescriptions being left at the counter because of all these pricing issues that I talked about, and because people really can't afford to spend hundreds and hundreds and hundreds of dollars every month on a prescription when they have when they have children to care about, when they have bills to pay, and other things. So all this is translated into sky high NPS scores for GoodRx of plus 90 versus a plus 40 for UNH. These can be fudged really easily, but the NPS scores, again, have been ticking up. So the trend is what I pay attention to, and it's been very positive. And yeah, so why do PBMs choose to integrate with GoodRx? I think is a good question to help answer. So PBMs don't collect what's called a manufacturer rebate when conducting a sale through these networks. I'm throwing out a lot of vocabulary, and there's a free deep dive on my Substack that covers all of this. So if anything's confusing to you, just go to that, control F a term, and it'll be defined. But as briefly mentioned, they don't collect they don't collect this fee from insurers, but what they do collect is a fill fee from a pharmacy, and what they're doing is they're splitting this fill fee with GoodRx. And why they're doing it is because leveraging these cash businesses essentially costs, and these transactions essentially costs the PBMs nothing. So they're fixed cost businesses, meeting all this incremental volume that's flowing through their operations directly feeds their bottom line, even though a little bit less aggressively than it would if they were going through an insurer. They're still happy to go through this transaction. And for evidence of how happy they truly are to go through this transaction, GoodRx's take rate, not only savings rate, is also rising. So just to give you a hint of how much value they're providing, their take rate several months ago before the IPO sat around 13%, ticked up to 14%, then 15%, then 15 to 16, and now it's 16. Their largest competitors, think about Single Care, they've seen the opposite happen, take rate compression. And that is a factor of GoodRx having more scale, better savings rates, and more consumers, again, to attract to their site, where they can justify, while still delivering appropriate return on investments to all stakeholders, they can justify this higher take rate. And it's not just consumers that are visiting the GoodRx site. It's also physicians. So over 25% of their visits are from physicians. And again, physician NPS score of not plus 90, which has been precipitously ticking up. And why that's so important, that's a good transition into GoodRx's second product, which is maybe even more exciting than the first, but it's called the Pharmaceutical Manufacturers Solutions. So the prescription pricing tool is predominantly for branded medications, as is all the other competition. So GoodRx, knowing this, wanted really to deepen the value proposition to cater to these customers. Sorry, I'm losing my train of thought. But essentially, they knew that 20% of their branded searches on the site, or of the searches on the site, were for branded drugs. They weren't providing discounts. There was a large gap in their value proposition, and this is how they really fill it. So what they're doing is using this exact same GoodRx prescription pricing platform and this app to provide or to list discount programs and promotional programs that all these branded manufacturers love to offer, because they are really expensive drugs, and these branded manufacturers are predominantly fixed cost businesses, again, so they can afford lower selling prices in exchange for higher volume. So they want to offer these programs, but at the same time, only 3% of Americans who are eligible for these programs actually know about them. So there's very little awareness. And what GoodRx does is it provides a channel of extremely highly relevant borrowers, or not borrowers. Sorry, I was doing some work on SoFi before this, but extremely relevant consumers. And just to kind of quantify it, they attract to GoodRx's site. GoodRx attracts 10 times more traffic than any of these branded manufacturer marketing channels can enjoy. And then they're doing so while delivering really eye-popping return metrics like an 8x ROI for a top 20 branded manufacturer, which is leading to things like 150% net revenue retention and really positive momentum, not just in penetrating the top branded manufacturers, but in also selling them more solutions and catering to a larger part of their portfolio. And why this is so exciting. First of all, the revenue is tripling year over year. It's a small portion of revenue, but it's quickly becoming bigger. But again, GoodRx is really not spending a lot of money for this incremental business. They are simply leveraging this 20 million monthly active consumer per month base of scale that they've built to sell more products. So it's really cross-selling, it's really upselling, and it is. In the words of their CFO, Carson Vorman, it directly feeds their bottom line. It directly feeds their net income line and their free cash flow, which should lead to some positive margin momentum going forward as this channel really explodes. So next product to talk about is their telehealth offering. And I've talked for 15 minutes, so I'm going to give myself like 10 more minutes and then force myself to stop talking. But multi-pronged telehealth offering is another thing that GoodRx offers. I talked about this a little bit last week. Telehealth is tough. It's extremely commoditized. You need to be the biggest with the most services to win, which is why I like Teladoc a little bit, even though the stock has been a dumpster fire. But the investment case here for telehealth is very different. So knowing that it's extremely commoditized and that it's extremely competitive, what GoodRx really is doing is they're using their telehealth offerings as a cost-neutral marketing vehicle to cross-sell their other higher value products. So they're not trying to collect any variable profit from this offering or from this product. They're using it to uplift and augment the volume and the growth from their other products. And it's working. So, or let me try and find that statistic. So 60% of Americans, or I'm sorry, that's the wrong statistic, but over 65% of these GoodRx care visits have now translated into cross-sell revenue for GoodRx, and more than 40% of these visits have also translated into one of their subscription offerings, so a subscription sale, which I'll get into now. So GoodRx Gold, and they do another subscription through Kroger, which is called, I think, like GoodRx or Kroger RX powered by GoodRx. It's a mouthful, but not super important. So GoodRx since 2017 has been offering subscriptions to provide even more value for consumers. And the wonderful thing about this is when people, as a lot of you know, subscription revenue is more visible and more recurring, even for something like for prescriptions. So GoodRx can lean on this more predictable revenue channel to offer better prices through their PBMs while also generating 2 times the LTV that they would from their free prescription transaction product. So a lot of interesting stuff going on the product suite. Doug Hirsch has told us that they're going to branch into things like insurance. They're not going to become a principal carrier or an insurer, but they are going to do some things in the insurance marketplace space where they think that they can play a much bigger role in our lives. So that goes into optionality a little bit more. And then really the focus for GoodRx, or a new focus that I'm excited about is B2B, so business to business. So GoodRx has been an inherently purely consumer-facing organization, and that really is no longer the case. So with companies like USAA and DoorDash, they've recently signed new agreements to offer over 1,000 medications for under $10. So think about how GoodRx can aggregate demand and attract more PBMs and lower their prices even more. This is how they do it in giant lumps instead of one person at a time. And these 2 early deals, I think, in Doug Hirsch thinks, in his own words, so I should say he thinks that this is a sign of many more things to come. They've also recently signed a deal with Fetch Rewards, and it's 10 million monthly active consumers. This is a receipt refunding service with over 1.8 total receipts submitted. So you can kind of intuitively think how well this will plug into the Fetch Rewards system and how relevant that will be to their really price conscious consumers. There's a few other growth opportunities that I'm going to skip over for now if you're really interested. The deep dives there and free. But the market, another reason, and then that'll naturally lead me into some competition. So the market is massive. So the current prescription TAM sits at around 360 billion. GoodRx is by far the market share leader, but the opportunity is still very untapped. So this 360 billion is growing at a compound annual growth rate of 5.7%, so above the rate of GDP or run rate GDP, which is always nice. But at the same time, that statistic that I offered, about 30% of prescriptions being left at the counter, that translates into another 164 billion in possible total addressable market for a company like GoodRx that can power broadened access, which is, I mean, that's their bread and butter. GoodRx's pharmaceutical manufacturer solution TAM, this was hard for me to find. They did offer a $30 billion metric, but that's from 5 years ago. So I think it's pretty safe to say that has gone up since then. But just to be safe, we'll call it 30 billion and move on. Telehealth TAM, it is a massive market, 250 billion. But again, GoodRx is not trying to profit here. So that revenue again should be considered a cost neutral marketing vehicle and not really something that's going to feed their EBITDA or net income line in the long term. What should I talk about next? So leadership, Carson, the two co-founders still share an office roughly a decade later, and they are still the two co-founders and still play instrumental roles in the company. So love to see that. Glassdoor scores are sky high for both Doug Hirsch and Trevor Bezdek. That's the two names of the two CEOs. The tenures for this company and have been several years, which for a lot of these startups and these companies going through large transitions, which I mean, seasoning a product suite as quickly as GoodRx is done and going public, those can be classified as these transitions. They sometimes lead to revolving doors for executive suites, and that has not been the case for GoodRx. They cite things like bonding events and workplace culture activities, but that's a really minor part of the bull case. And then, I should talk about financials. I haven't talked about financials at all. So this company kind of, I mean, it's setting a new all-time low today. It's just swept up in that indiscriminate growth stock shellacking that I've been talking about the last few weeks. But to me, I've been taking it as a really exciting opportunity, and I'll try to explain why. From a quantitative perspective, that has been the case. So last quarter, revenue grew almost 40% year over year. And their prescription transaction revenue, which is the largest piece of their business by far, is still being hurt by this COVID-19 pandemic and by these various variant outbreaks. So if you think about it, social distancing and people going to bars less or going to school remotely means we need less elective care and we need less prescriptions. That directly serves as a headwind for GoodRx's main business. And yet they were still able to post this nearly, or let's call it 39% growth year over year. So from a demand perspective, things look very good. Q over Q net monthly active consumer ads are accelerating. Subscriber ads are very strong. But then one of the exciting things about GoodRx is the margin profile for a company growing at this pace. So gross margin 94%, pretty good to say the least. EBITDA margin of 32%. Net income margin of 20%, cash flow from operations margin of 25%. I mean, when we see these companies that have a great chance to compound, let's call it at a 25 to 30% rate over the long term, it's not very common. I mean, the gross margins are often excellent, but it's not very common that we see cash flow and EBITDA and net income margins as seasoned and as mature or seemingly as mature as GoodRx is right now. That was a little bit of a weird sentence, but hopefully you got what I was saying. And that translates into a company that's supposed to compound at least over the next 2 years at a rate above 30%, trading at an earnings multiple below 40 times. So not really priced for a whole lot of success, but since they've been public and since they've offered guidance and even the most recent management interviews that I've listened to have been extremely upbeat. They've consistently under-promised and over-delivered, barely over-delivered, but again, barely over-delivered while they've dealt with this unique macro headwind of COVID-19 hurting the largest part of their business. Last thing I want to talk about, because it's been 22 minutes now, is risks to the bull case. So the first one that we must talk about is politicians. So when you invest in GoodRx, you inherently expose yourself to political risk. We are one piece of legislation away from their business model being abruptly changed, but that's been true for over a decade now. And I'm gonna read a quote from Doug and then move on to the next risk, because I think this sums it up really well. Every administration has tried to fix the broken healthcare in this country, and none have had any impact. Nothing we see, regardless of passing or not, has any impact on our business. So that sums it up well. And then moving on to the competitive risk. So big bad Amazon is trying to take a little piece. It's not clear how serious they are about this yet, but a little piece of GoodRx's pie. They've had, and I quote, virtually no usage to date. Third-party data shows they have a few hundred monthly active users. And GoodRx's pricing is, and I quote, dominantly better than Amazon at this point in time, because again, it's really hard to convince 15 PBMs to accept this still great but lower margin business in the cash pay section when you don't have 20 million consumers coming to your service. And Amazon, while they're capable of doing so, I mean, more capable than pretty much anyone in the world, they haven't done so yet. And really, why that is, I think is really interesting. And I think, very interesting. I'll leave it there. Is Amazon is really focusing on building a mail delivery service. So for the pharmacy specifically, mail delivery is really not gaining any traction. So penetration topped out at around 5% during pandemic periods, and it's since then pulled back. So why is this? People use pharmacy visits to buy a lot of other things like toiletries and stuff like that. GoodRx has stated that cross-sell activity is around $52 for these people visiting the pharmacy. And then also, what's interesting is for most of these prescriptions, if it's not $1 or $2, but if it's above $10, or I don't know what the actual benchmark is, but for a certain price, the person has to be at the door signing for the prescription when it comes. The FedEx or UPS delivery driver will not leave that prescription there for us. So if we are not home, they will just leave without our prescription in hand, which, based on the time sensitivity of a lot of these prescriptions, makes a lot of people nervous and pushes a lot of people to continue going to the pharmacy, which amid this massive shock, e-commerce shock that we had during COVID-19, not even that could push penetration rates above 5%. And again, that rate is now falling once more. So having said all of that, there's few entrants that are more capable of success than Amazon. But that just goes back to the fact that this is a massive market. And not only is it a massive market, but still 7 out of 10 Americans don't know that these pricing inefficiencies exist. So GoodRx, kind of borrowing from Reed Hastings from Netflix, talking about competing with screen time. GoodRx is competing with Amazon, but they're also competing with awareness of their services for these 70% of Americans. So what is that? Like almost 300 million Americans that don't know about this opportunity. So while Amazon could succeed, and while Mark Cuban's recent startup that people are concerned about could succeed, I do not see that success as culminating in a winner take all for a several $100 billion market, but as a several winners are going to have a lot of fun in this market. So there's a lot more to talk about, but for now I will leave it there because that's 26 minutes, and I think that's probably enough time for you guys to listen to me. But if you go to my bio, the link to my Substack is there. If you're interested in the company, everything you need to know, a really in-depth version of what I just did, is there for free. So knock yourself out. And thank you for having me, Evan. And Wolf, happy to answer any questions, and excited to listen to our next speaker.
Yeah, definitely check out all that stuff that Brad puts out there. It's fantastic content and information. And you know, the best way you're going to utilize that stuff is look at how Brad, someone who really puts in his work on the back end, look at all the numbers that he's looking into and the type of stuff that he's putting out there. It's that concept where, you know, you can give someone a fish and they will eat. But if you teach them to fish, they will eat every single day going forward. And it's not just like looking at what he says, but looking at the type of stuff that he's looking into, the type of things that he's looking into, and kind of what he likes about a stock. Brad, in the future, I need you to give us a little bit of less like amazing and perfect, breakdowns on stocks. I have no questions. You took all my questions in there. I do still have one, so we'll keep it brief on it. But you're making it difficult for the host, but I love it. I'm all for it. So
should we talk about Michigan basketball struggling for a couple minutes to fill the void?
Nah, listen. You want the honest truth? It's football, and the rest of it, Michigan can succeed for me. That rivalry of OSU Michigan is a pure football one for me. But yeah, dude. So yeah, I feel like this might be a typical thing on FinTwit and around here, or maybe I'm just in my own little bubble. But investing in pharma, investing in medical and healthcare space is really difficult. Alex brought up earlier, when you want to start this long-term investing, a great place to do it is in a sector that and can easily wrap your head around. Retail, whatever it is, some people it's video games, everyone has their own thing. for me personally, healthcare and everything like that could not be further from that. So I do struggle a lot with doing my due diligence and research into this sector. A lot of sectors have those key numbers and key terms and key whatever that you have to be looking into. I think of Netflix service level, and the first thing you go to is subscribers, and a couple of numbers like that. Yeah. But what are some of those really typical and key terms in healthcare? I know that's a very broad sector. So maybe with GoodRx in general, that you kind of have to prerequisite know or to expect to look for when you're doing this research. Or
Yeah.
honestly, dude, Brad,
Oh,
on top
sorry.
of that, any tips for getting? No, my bad. I added a third question on the top of the other two I just did. But yeah, for anyone who wants to get into investing in healthcare and picking these individual stocks, you got to throw it on there. If there's anywhere you'd start or whatever. But yeah.
Yeah. So I'll preface this with saying, in terms of circle of competence, so that term that I steal from Warren Buffett, my circle of competence for healthcare does not include things that you ingest or inject or anything like that. So if you need an FDA approval for a pill or for a vaccine, that is outside of my circle of competence. And like genomics, same thing. I don't touch any of that. I'm really focused on healthcare services. So with that being said, some of the KPI or key performance indicators for GoodRx for their main business is really prescription transaction volume and prescription transaction revenue. So nothing too fancy there. But another two key demand metrics that I'm focused on is their monthly active consumers. So that is paid and free consumers. So how much demand they're attracting to their app, which not only does that lead to more prescription transaction revenue, but it also leads to more value that they can provide to these branded manufacturers, so that they can charge more and sell more products and represent a larger part of their portfolio. And then also, so monthly active consumers, and then I kind of fudged a little metric myself, subscribers divided by monthly active consumers, to see how it's a way for me to gauge how much value consumers are really deriving from this subscription product, which for GoodRx, I think it's around 20%, which is pretty good compared to a lot of my other companies. So and that's really a product of discounted telehealth services and better savings rates, but I won't go into that anymore. So it's really, from a demand perspective, it is prescription transaction revenue and then monthly active consumers and subscribers. And then from a margin perspective, it's EBITDA right now. So they do have a net income margin, and it is 20%, which is pretty damn good for a 30% plus grower. But so the thing with this, so I guess I am looking at net income margin, but for EBITDA margin, which has been well above 0% for a lot longer, which is how I have a much longer trend, so I can kind of glean more information from it. But with the introduction of this telehealth product, their EBITDA margin's gone from like 38% to 31%, because again, they're collecting all of this revenue and it's really translating into zero operating profit, and that's by design. So we've been told to expect that this EBITDA margin erosion or contraction is going to revert in 2022. So in terms of profit metrics, that's really what I'm focused on for 2022. I want to see 31.7%, or actually 30.9% last quarter. I want that to be a thrower, and I want that to be a bottom, and I want to see that start to go up. And I really think the pharmacy benefits manufacturers solutions, what a mouthful, but I think that product is going to be the instrumental part in making that happen, along with their prescription transaction revenue for generics coming back as COVID, hopefully, fingers crossed, continues to fade away. So those are the focuses.
Perfect. Thank you, Brad. In depth, super amazing as always. Make sure you are checking out Brad. Make sure you're checking out all the speakers that we have up here. Brad, do you have a YouTube channel, by the way?
No, I just do a lot of writing. I like to write. I don't know.
I'm just throwing this out there, that 20-minute breakdown that we just went through there would make some fantastic YouTube videos that a lot of people would love to click into, and it's kind of what you're already doing. So I would definitely watch those, and I know a lot of people would get value out of that. So maybe something to think about, or maybe not, because the writings are so fantastic as they are. But make sure you're checking out those writings. They are in Brad's profile. As he said, everything he does is free, and definitely a great thing to check out. Make sure I did just say this again, but make sure you're following all of our speakers up here. I'm going to keep doing this and throwing this in here, but we selected the panel to come up here. We didn't just get random people. These are all amazing long-term investors with a lot of knowledge to give. I know Stock Talk does a good amount of trading as well, but he does a lot of long-term investing, has a lot of fantastic tweets. Make sure you're following all of them up here. And with that, I would love to throw us over to Stock Talk, talk a little bit more about how, as a long-term investor, you can capitalize on volatility in the market, which has been happening a lot over the last couple of weeks. Stock Talk, I'd love to throw it to you.
Yeah, man. I mean, I didn't prepare, too much, but I mean, I feel like I can talk about this topic because it's something that, I've gone through myself. When I first started, I guess, trading, investing, I was just purely a stock picker and investor and, buy and hold, average down, dollar cost average, and didn't really do much else. And, I went from making a lot of money, seeing a lot of money disappear, unrealized gains disappear, being over leveraged on the long side at times, having just no ability to benefit, profit, or capitalize on volatility and downside. And I think that's really the next step in evolution for most investors. I don't believe in the term passive investor. At least not in the long term. I think it's very difficult to do that unless you're just strictly dollar cost averaging into the S&P 500, which if you're doing that, then what I'm about to say over the next few minutes is probably not as relevant to you. But if you're picking stocks, whether you're investing or trading, if you are a stock picker, then that's inherently speculative either way. If you're picking individual stocks, then taking a long-term position is, in fact, in some ways more speculative than trading because you're depending on long-term assumptions of execution and growth, which inherently over the long term, there's more variables involved in that, right? There's changes in the competitive environment, changes in the monetary environment, changes in consumer preference, changes in technological advancements. And sometimes it's flat out just relevance to the market. Historically, themes come and go in the market. There are industries that trade, across the board at 50x sales for a few years. And then a few years later, they're all trading at 10x sales. That's just an example. But the reality is this happens recurrently. And, there's sectors that go from being sexy in the market and having high multiples across the board to a few years later just not being in favor. And, that's why it's so important to rotate your portfolio accordingly and to try to have some sort of flexibility and not just, die on a hill, not just say, these are the basket of stocks that I'm going to hold and they will, appreciate indefinitely because, most investors simply watch the volatility. And that's the reality. They're bystanders with their own money. And, I've spoken about this before. I don't know if it was yesterday or the day before on one of your spaces, Evan, but, there's a myth in the investing community that simply dollar cost averaging into your favorite stocks and being patient is going to inevitably pay off into the long run. And the reality is that it won't. The vast majority of stocks, especially hyper growth stocks, they don't sustain their growth and, for more than a few quarters or a few years. Like I said earlier, competitive changes, challenges with scale, changes in the broader, just even pure dilution of the competitive environment by introduction of competitors, whether they're high tier competitors or low tier competitors is actually not even as relevant. It's just simply the dilution of the competitive environment that happens in most industries. As industries, emerging industries become more and more lucrative, get more and more attention from the market, get more and more market share, inevitably more competitors emerge and they dilute the competitive environment and makes it harder to propel exponential growth. And that's why you see most sectors, demand, while it increases, gets absorbed by the introduction of additional competitors who are doing different things, differentiating their products in different ways and stealing portions of market share because of that. And so what seems like a perpetually growing business today, may not in fact be one just a few years down the road. And this is why constantly reanalyzing your positions is so important because, if you don't do that, if you don't consistently reevaluate your positions and ask yourself, is this company doing the same things it was doing when I deemed it a good investment? If you're not doing that, then you really are being a passive investor. And you may survive in the market if you're a person that has another significant source of income that you continually inject in the market. but your portfolio won't perform well if you're that passive, truly. And so, that brings me to the topic of what, I wanted to briefly talk about, which is just, being aware of, and, if you're sitting on cash and you're an investor, rather than only having one funnel for that buying power, which is either dollar cost averaging into your position continually, there's other things you can do with that capital in the meanwhile, to, either control your losses or benefit from the downside. One thing I talk about a lot is selling covered calls, which is something that's very simple and that not nearly enough people do, especially new investors. I've tweeted this before, and I'll say it again for those who haven't heard it. If you own over 100 shares of anything, you should be selling covered calls. And the quickest response and the quickest contrarian view on that always is, well, I don't want to lose my shares, right? Or the premiums aren't high enough. Well, the reality is money is money. So if you're so married to your shares, right? If you're married to your shares and you're like, look, I don't want to lose my cost basis, I don't want to sell my stock, then sell calls that are so far out of the money that you benefit, and those premiums are purely jacked up because of the implied volatility. In a climate like this, where you see so much chop in the markets, the people that are making the real money are the options writers, right? People who are buying calls and puts are getting burned on both sides, with the Qs opening up and then getting faded and then popping back up and then getting faded again, and the SPY doing the same thing. Premiums are getting burned on both sides. So the people who own shares and are writing options are making a killing, because when you see these stocks on moves that you think will get faded, when you see these stocks, with jacked up IV and you're holding shares, selling covered calls is going to be very profitable, even at strikes that personally the stock will never get to. People are always gambling. There's always gamblers in the market, and you might need to evaluate the options chain and look at the OI and look at the IV and find the right opportunities on an options chain. But having that tool in your pocket gives you an ability to earn profits on a position without ever selling your shares. So if you truly are an investor who's like, I want to accumulate shares in this company, I do not want to sell my shares, I have faith in the long-term vision in this company, regardless of how good of a company it is, it's going to be volatile, right? Look at all the best companies, or all the quote unquote most favored companies, the most talked about companies of 2020 and 2021. They're down 50, 60, 70% from their highs. If you were just purely a passive investor who owned a bunch and just kept buying on the way down, you're either severely underwater now, or you were a bystander to all of that volatility and you made no money. If you had sold covered calls along the way, you would have recuperated a lot of money if you had been doing that every month. For the last 2 years, people who've, there's people that DM me and that comment and that I talk to every week who are still holding stocks they bought in 2020, but they've never sold a single covered call in that position. So if it's something you're not doing, I highly recommend that you explore doing it. And the more bullish you are, the further out of the money calls you can sell at shorter dates. And if you're indifferent to your position, if you're like, look, I would, if you're holding a stock that's trading at $38 and you're like, look, I would be so down to sell it at 42, then sell covered calls that are closer to the money. And if it does hit 42, oh well, you'll sell it. But you can't you can't look back and be like, oh, well, the stock went to 45 and I sold it at 42. You have to be happy with the profits if you're going to employ this position. And again, like I said, if you really don't want to lose your shares and you don't want to take, have to be forced to sell them, then sell calls that are so far out of the money that, barring a massive catalyst or short squeeze, the stock won't go to those levels anyway. And the premiums won't be as good, but you're still making money. You're still adding positive money to your account, right? Which a lot of people aren't doing right now. Right now, a lot of people who are passively investing are just watching their portfolios go down, just like deer in headlights kind of looks. So, it's in your benefit to at least seize the opportunity cost in some way, whether that's capitalizing on the volatility or just earning incremental profits week by week or month by month or bi-monthly, whatever rate at which you want to sell those calls, right? So that's one thing you can do. Another thing you can do is you can own a position, and if you have cash on the side, rather than directly DCAing in, you can do this if you have a separate portfolio. maybe a trading portfolio. You can just buy a peripheral position in the same stock, in equity, in calls, in puts if you think it's going down, and use that to trade and profit off of the volatility. So you're not just dumping more money into a position that could go down further and further and further, right? Because even if you're great at technical analysis, and there's some fundamental investors I know that are still great at technical analysis and they know the levels on the chart. If you look at the last 3 months of price action, how many stocks have forfeited major key levels, not only historical levels, but technical levels? A ton of them. In fact, the vast majority of growth and tech stocks have forfeited those levels. So even if you were a disciplined dip buyer, right? Even if you were a disciplined dip buyer that waited for these stocks to get to supports and you go, you know what, I'm deploying more capital here. I mean, the capital wasn't wasted. You still own the shares. But how much did you compromise your position by buying there rather than waiting and deploying the capital that you used to buy that dip to do something else, like play puts? Which brings you to another point, which is that not enough people are hedging. And when they are hedging, they're hedging, not deliberately. They're hedging like with such small amounts. They'll be long, with $400,000 of capital and hedge with, $2,500 in puts. That hedge isn't going to do anything for you. That hedge isn't going to actually moderate your downside. That's just like a speculative position. You're taking a little bit of extra cash and throwing it into there. If you're somebody that's looking at this monetary environment and you are of the illusion that like stocks have a reason to rip right now in this climate, I mean, they don't. We have inflation running rampant. We have the Federal Reserve tightening policy, and they almost seem like they don't know what they're doing. You have geopolitical tensions. You have potential quantitative tightening at the end of the year, start of next year. Now, SPY outperforms generally, even in environments of rate hikes. But will your individual stock do that? And if it won't, then why aren't you playing both sides of the ball? So you can sell covered calls. You can trade a peripheral position. You can play downside with puts. You can play downside on your own position. If you own equity in a stock that you know is going down, but you don't want to sell the shares, then you can buy puts as well if you're not going to sell covered calls. And some people feel like that's counterproductive. But the reality is that most traders don't have enough capital to materially affect their position by participating in the downside. But it's a lot better to do that than simply watch your stock go down, but just to simply be a bystander and watch your stock go down, especially if you're not planning on buying the dip, which in this climate, again, is so hard to do, to catch these falling knives. So, you can do any of those things. And if you don't want to hedge, or if you don't want to sell covered calls, which, again, I don't know why you wouldn't want to do. It seems like the obvious thing to do in a time of volatility. Then you can rotate your positions according to the monetary environment also. You can pick up exposures that you think will outperform. You can pick up exposures when they're hot. You can trade themes and sectors. You can rotate into financials when you feel like the monetary environment is tightening. So there's a number of things you can do rather than just sit on the sidelines and watch your portfolio go up and down and up and down and up and down. Because by doing that, you're wasting opportunity cost. You're allowing your portfolio to tank, which many people have for this entire year. I know really good investors who are down like 40% on the year, and it's only been a month. So, allowing yourself to become a bystander with your own money, I think, is very dangerous. And considering that there's so many things you can do, not just with options, you can do it with equity, and you can do it with simply selling options that are covered calls. There's so many, low risk ways that you can participate in downside that people aren't employing. And part of that for new retail traders is, I think, a lot of the GME and AMC frenzy, which like demonized playing the downside and then made it, feel like an ethical violation, which it isn't. You're here to make money. That's the purpose of what everybody should be here for at the end of the day, is whether you're an investor or a trader, you're here to make money. And so if the market is going down, you have every reason to believe that, then you should be participating in that downside in some way, whether that's through a hedge or playing the downside directly.
Love that. Stock Talk, that was a fantastic explanation. As always, really appreciate you coming here and giving your fantastic insights. And I think this kind of fits into your broader theme of everyone should really be a long-term investor and a trader in there. And, there's different levels to it. That person can 100% be long-term investing 99%, but it's taking that optionality when you have your positions and not just being that passive bystander watching stuff go up and down. Because truthfully, I know I have been a victim of this for a while. It's maybe a little bit different for me because I have a Twitter account where I'm doing this all day, but I will check my portfolio X amount of times in a day. When I know I have how many moves I plan to make that day is absolutely zero. So I 100% agree with you there, and then definitely something that all of us long-term investors should be doing more of. I kind of want to dig a little bit more into that. I think it kind of goes down the theme of everyone, like I said, should be that long-term investor and a trader. What are some more, methods, things you use, whatever it is that traders use? The first one that comes to mind is technical analysis, and maybe how some of those things could be utilized for long-term investors. Is there any single one of those that come to mind? Yeah, technical analysis. I would love to hear your explanation on maybe how long-term investors could use that, or any other ones that you think are super important.
I think long-term investors have to be technically literate. You have to understand, if you are going to be a dip buyer, you have to know that you're buying, a dip at the appropriate time at a key support, because, a lot of people I see they'll love a stock and they'll see it have like a -5% day. And they're like, all right, I'm buying it because this is a dip. But that's not like what dip buying is. Dip buying is buying at like places that you think the stock is going to bounce from. The issue with doing that in this market is that, people who are looking at anything more than an intraday chart in this market, you can't rely on that. That's why day traders are excelling in this market, because if you're trying to swing trade something or look at like a medium to long-term chart and you're trying to make an assessment based off that and say like, hey, this stock's at a key support, I can buy here and hope that it'll rebound. That's not going to be very reliable, because this is a sentiment driven market. And, as we've seen, it's very hard for people to make, predictive calls on where SPY or the Qs are going. So yeah, you should be technically literate. If you're an investor, you should still know about, VWAP, RSI, MACD. You should still know about SMAs, EMAs, supply and demand zones. Yeah, you have to be technically literate is the thing I would say on that. Regardless of if you're a trader or investor. With regard to other things that they can do, explore optionality, explore adding, some of your cash that you're wanting to deploy, add some of that to participate in the downside, rather than just deploying it defensively. Like deploying it as a dip buyer or as a dollar cost averager. That money can often be better deployed playing the downside, whether it's on a name you already own or on the broader market. If you want to go, with SPY and QQQ puts, or if you want to go on puts on an individual stock you own, or if you want to go with puts on what you think is the weakest stock in a particular sector. There's a number of ways to do it. Or if there's even downside catalysts for a particular stock that are on the table, if that's like an offering or, those kind of stocks where you have the additional fuel of a downside catalyst and, the broader market is turning down, that's great to play. The reality is like, look, if you're just going to sit here and just like wait for this year to pass and not do anything, more power to you if you can survive doing that. The reality is, though, a lot of people have gotten margin called, have blown up their accounts, or, their accounts are down 60, 70% because they have been passive. And if they'd been active and hedged their portfolios or played the downside, that wouldn't be the case. They might still be down, but they wouldn't be, in shambles, just like completely have blown up their portfolios, which I know really, really good investors who do the best fundamental research, who are like, really apt in analyzing companies and valuations, that have not made $1 in months. And so it's because they're not willing to participate in short-term trading. They're not willing to participate in playing the downside action. And so, yeah, those are the two big things. Learn your TA, of course, but at the same time, don't over-rely on it in a market like this. It's much better to just go with the theme. And right now the theme is that every rip's getting faded.
Thank you, Stock Talk. I appreciate that. I'm going to throw in one question here. This might be a little bit more for short term with it, but I do still want to kind of come in here and ask you, maybe we can make it useful for long-term investors. You kind of made a point there with market rotation and how the market shifts throughout the year. A lot of the times the indexes will be doing one thing, but there's a lot going on under the cover in the sectors and everything like that. So I just kind of want to maybe like from the long-term investor perspective, how do we deal with that? How do we deal with the sectors changing and making sure we're constantly putting our portfolios in the places that are working while still, being in those long-term conviction names?
Well, I mean, that just depends. I mean, that's a very broad question. I mean, that depends on, the market conditions, what's happening. In this environment, I think what's happening is relatively straightforward. It's just a compression in high multiple names, which is why you see indiscriminate selling in pretty much everything related to growth in tech. It doesn't even matter what sector you're in at this point, whether you're in chips, whether you're in financial services, whether you're in algorithmic lending, whether you're in electric vehicles, whether you're in anything. Look at any high growth tech sector since October. And it's the exact same story, right? So knowing that, in this kind of environment, you have to look for sectors that have a reason to outperform. For me, going into the summer, I think going into the first rate hike, especially in November, I think financials have a reason to outperform. At a certain point, the yields will top out and those will also reverse. But, there is at least sentiment and tailwinds behind financials to have a reason to be long them going into the summer. Oil stocks, energy stocks, that's another thing that could find themes. But granted, those are going to follow oil prices as well. So you have to be nimble. But there are not a lot of themes this year, at least in terms of quote unquote sexy stocks, growth tech, anything interesting this year that has a reason to go up, because most of those stocks are very high multiple names. The vast majority of them are. And, if you look at the SPY and you look at the quote unquote first rate hike, if you use that as a date and you look historically, around the first rate hike, 3 months before, you see a relative underperformance in SPY. 6 months before you see, 6 months before you see an underperformance. 3 months before you see SPY start to go up. 3 months after and 6 months after, SPY relatively outperforms. Does that mean the individual names within it will outperform? No, because there's so many high multiple names in SPY and the NASDAQ, mostly the NASDAQ, and in small caps, IWM. I mean, there's tons of high multiple names. That's why, again, even going back to last February, when you saw the D-SPAC collapse last February, when Lucid crashed from 60 to the 30s and pretty much every other D-SPAC followed, that kind of was the first indication of breadth really slowing down. And all the way from last February through pretty much now, you've seen this massive lack of breadth in the indexes, and the things that are getting hits are the big boy stocks. And we've even seen weakness in those too. I mean, look at what happened in Netflix, right? Peloton was a darling child of many people last year. Upstart was another stock that people were drooling over last year. These have all gotten pummeled. So there's very few stocks that are holding up, and you have to be nimble to find them. And I'm not saying it's an easy market to do so, but there are certain sectors where you can find a reason for them to trade higher in the short and medium term. I think financials and energy and oil stocks will be a theme this year at certain junctures. But granted, we've even seen volatility with financials lately as well. So it's not something that's just easy peasy lemon squeezy, buy a sector and hold it. You have to continually analyze the monetary environment, analyze sentiment, see where the money flow is going. Like I'm typically a volume-based trader, and I've been trying to determine volume trends in a lot of different sectors lately. And it's been more difficult than usual because there isn't a consistent story. It's not like we're seeing these massive inflows into financials that you can follow and depend on to swing trade them. Same thing with energy and oil, where it's sporadic. You're seeing them be in favor for a week or a few days and then go out of favor with the broader market. So it's a hard environment right now for sure, but you can at least be doing things to hedge your portfolio. You can be doing things with your holdings like selling covered calls, and at least trying to generate some profits on the periphery in the meantime until the market finds some direction or actually picks a sector that it's going to give consistent favor to over enough of a period of time that you can start swing trading again. But this has definitely not been a swing trader's market, I think, for at least the last 6 to 8 months.
Appreciate that, Stock Talk. Like I said, make sure you're checking out Stock Talk and all the other speakers up here. They're giving you such amazing insights from a bunch of different perspectives, mostly long-term investing 100%. That's what we're here for, to get you guys those gains for the long term. We are going to slowly kind of move us into wrap-ups. To all my speakers up here, I'm totally cool with this being a 15, 20-minute wrap-up. Whatever you guys got to do, if it's like, you really, there's parts you want to talk on, or even if it was talking points that you wanted to push us down, I am totally cool for it, even if we want to do a very quick wrap-up, whatever you guys want. But before we do that, if you know me, if you've been in these spaces before, we cannot do an hour and a half or whatever spaces without getting to the number one thing, the number one tool that we have created, the Google Spaces calendar. And for that, I'm going to throw it over to my wonderful co-host on all these spaces, pretty much every single one, Wolf_Financial, to get us through that impeccable product that we've created.
Thank you,
Free
sir.
product. Yeah.
Absolutely. For anybody who's been tuning into our spaces this week, and you could take a look at my pinned tweet to get a better vision of what's going on, we are doing 20 spaces this week. That's the most that we've ever done. That covers about 30 plus hours of content on every major investment topic, whether that is stocks, long-term and short-term investing, crypto, NFTs. We have option trading, investing in specific sectors such as cannabis, oil, energy. Everything that you can think of, we have got it for you. But there's so many of these spaces, and many of y'all are not spending your full day on Twitter like we are, but you want to know when these spaces are, who's speaking on them, what the topic is, and how you can tune in. With that being said, we have gone ahead, myself and the other co-hosts up here, Stock Talk Weekly, Stock Market News, and we've collaborated on a one-of-a-kind product, which is a free public Google Calendar that anybody can subscribe to for free to know when every single one of our spaces is, and not just know when it is, but have it added right onto your personal calendar. The best way to get on this is DM right now to myself or the host, Bullish Rippers or Stock Market News. All of our DMs are open. Shoot us a DM, send over, and just ask you on the calendar, and make sure that your email is in the DM, preferably a Gmail. That works best because it is a Google Calendar. That's all you have to do. It's always free. You can join over 3,000 other investors that are using this on a daily basis, including hedge fund managers, CEOs, people with 1 million plus followers, even people at Twitter Spaces have DM'd us and asked to be on this calendar. It truly is a one-of-a-kind product. You will see spaces, the topic, who's speaking, the time, everything with one click on your personal calendar, and you can toggle it on and off so it doesn't even, clutter anything up. And then the best part is, once the space is done, you can see this is being recorded in the top left corner. We take that recording and we put it into the space. So no longer we have to scroll through the timeline to, go through hundreds of tweets to try to find the recordings, maybe even miss it. One click, go to your calendar, find everything in one spot. And if you don't like it, you can unsubscribe for free and it doesn't even send us a message. So make your life easy. Shoot us a DM right now. We will add you right onto this Google Calendar. Again, 3,000 plus people using it every single day. And it's all free. And it's just the best tool that we have. So hope y'all will join us on that. Back to you, Evan.
100%, all free, always will be free. This is one of the best things that we have created already, and myself and Gav, Wolf Financial, are putting in a bunch of work to make it even better. So we got some cool things coming on the background. I know I've been hyping it up, but I expect that probably, I won't give a time on it, but in the near future, whatever, we are always adding cool stuff to that Spaces calendar. But with that, I definitely want to get us into wrap-ups. Like I said before, I know we had a lot in this space, and a lot of the speakers maybe didn't have a good chance to respond to some of the other comments or thoughts from our other speakers up here. So if anyone wants to do that, feel free. Would love to kind of hear in general wrap-ups, any final takeaways from the spaces, any gems you want to leave people with, and then maybe anything you guys got personally going forward. Obviously, they're going to be huge fans of you guys from this spaces, your Twitter accounts. They're going to want to know what all of you are doing. So we'd love to hear that as well. As always, I throw a lot and pack a lot into these questions. It wouldn't be a Stock Market News Bullish Rippers hosted space without that. But Alex, I'm going to throw it over to you first for wrap-ups. Really appreciate you joining in. And yeah, we'll love to hear what you got going on. Any more comments you have on long-term investing and the spaces, or anything else you want to get out there?
Yeah, no, I appreciate having me on this Spaces. It was you certainly got a range of thought processes of how people approach the markets, which is always a good thing. And that's part of becoming an investor, is figuring out what works for you and what kind of style you want to have. Special shout out to Brad for that long and in-depth GoodRx discussion. It's a name I've looked at as well. It's I give him a lot of credit for even just getting your arms around that business is a high bar. So it really speaks to the time and effort he put into that. So I appreciated that. In terms of what I'm looking at lately, I just updated on Netflix's most recent quarter. I just released an article today about the Microsoft Activision deal, which I think is pretty transformative for their gaming business. I'll be back next week with an update on Microsoft's quarter, which is right up there with Berkshire. It's my largest holding, or second largest. I've owned it for a long time, as I said. So I'll have some thoughts on the business and working through the rest of the earnings calendar, but hoping to continue adding to the list of companies that I do deep dives on. Names like GoodRx is one of them. Looked at Airbnb recently, Spotify, a bunch of other companies. So you can check that all out on my Substack. And yeah, as always, anybody wants to ask me a question from beginner level question to whatever you think I'm capable of answering, I'm always more than happy to talk. So reach out anytime, Twitter, email, whatever works for you. So yeah, thanks again for having me.
Our pleasure. We were lucky to have you join in. The link to your Substack that's in your bio?
Yeah, the link to my Substack's in my Twitter bio. It's I think if you go to thescienceofhitting.com, you can get directly to it.
Perfect. So everyone go in there and check that out. Alex, we'd love to have you on another one of these spaces again. Thank you very much for joining in. Wolf, I see you got your hand up.
Yeah. Real quick, wanted to give a big thank you to Alex, for joining in on this. Brad, for doing this every single day with us, pretty much, coming on and giving in-depth insights for, a lot of different areas. Stock Talk, consistently holding tons of spaces with us. These are the people to be following if you want to be getting the best spaces on FinTwit. And then, of course, for anybody that just DM'd me, be on that spaces calendar. We got a bunch of DMs. As long as you're following the host, myself, Stock Talk, Stock Market News, you'll again see our spaces show up in your spaces tab, which they're going to be adding to desktop this coming month. And a couple of different areas, you will just have easier access to these. You can get notifications. We always try to put out reminder tweets. Again, this is just a full-time lifestyle for us. So appreciate everybody that's been joining up, that's been following, checking out our speakers. And yeah, back to you, Evan.
Wolf, my bad. I should have came to you earlier before we went into wrap-up. So is there anything you wanted to add with long-term investing or if you wanted to, if not, you're chilling. But yeah, definitely should have came to you earlier.
Yeah, it's all good. And we could tap Joey too. But right now, I still have, my long-term portfolio in place. To be quite honest, there's a lot of stuff in there that I wish I had put higher stops on. But at this point, with where the market's pulled back to, I'm kind of along for the ride, more supplementing it with active trades. Had that trade that's short on LC into earnings right now. LC has literally done exactly what I called for it to do. It filled the gap all the way downwards. It's actually under $16 a share now. So that's more of a short-term thing that I'm supplementing with. But when it comes to long-term, just learning, coming to these spaces to find great companies with strong business models and bright futures, learning how to supplement, my long-term investing with covered calls and other areas. So yeah, just taking it all in.
Fantastic, Wolf. I appreciate that as always. This guy hosts amazing spaces. I just spilled my water everywhere doing that. That's wild. Wolf hosts amazing spaces 24/7. A fantastic follow. You'll see everything on the spaces calendar, but definitely a must follow on the Twitter account. Appreciate you for joining in, Wolf. I'm going to get us to the rest of the wrap-ups. And Joey, when I come to you at the end, feel free to throw in anything you got with long-term investing. Would love to hear that. But I want to keep us moving on wrap-ups and give the mic over to Brad.
Nothing really to talk. Actually, I'll talk a little bit more about GoodRx. So I said a bunch of really positive fundamental things, and then you go over to the chart, and it is one of those falling knives that we have talked about by every sense of the imagination. So it's kind of balancing how much I really like the company and want to hold shares for a long time, as long as they continue to do what I think they're going to do, and continuing to double check and triple check and quadruple check to make sure. But into this falling knife, which I do catch falling knives sometimes, but it's really a product of that 35 to 40 times earnings multiple, providing a valuation base that I kind of see in terms of risk reward. So it's considering that, and then also respecting the fact that these bases have not even begun to form. So just going extremely slow, tiptoeing into these names as the fundamental risk reward becomes extremely favorable, but the technical backdrop becomes extremely, or continues to be extremely intimidating. So leaving you with that message, and then also on Lending Club, and I think that was a good example to bring up. I mean, the top line growth for the quarter and for 2022 was pretty damn good. But you look at the 2022 net income guidance of a midpoint of $1.30, and we were looking for $1.70, and that probably is where, especially in this tightening macroeconomic backdrop, especially where we're fearing balance sheet runoff and hopefully just passive balance sheet runoff, but earnings matter a lot more than they did 6 months ago or 12 months ago. So I wanted to talk about that. Growth is phenomenal, and revenue growth will power most of our very, very long-term returns. But especially right now, we care. Net income has become exponentially more important than it was a few months ago. So just respecting that and understanding that, I think is really important, and has guided a lot of the accumulation activity and directed it for me to the names that do have this net income line and this pretty favorable multiple. So I'll try not to talk for another 25 minutes. That's all I have, and thank you for having me as always.
Ooh, I forgot to mute. Brad, where can we see all the stuff you write?
Yeah, so I appreciate you giving me the opportunity to talk about it. So if you click in my bio and just click on the StockMarketNerd.com link, it will take you to my 100% free Substack, and I cover 23 names, including a lot of these falling knives. So if you're really intimidated by some of this technical action, but want to learn more about the companies and their future long-term prospects, that's really where I focus. For a company like Upstart that's gone from 25 to 400 to 80. I mean, I just think hopefully, or I like to think that providing all of this fundamental information gives people a sense of comfort and a sense of familiarity in what they own to kind of to contextualize these moves a little bit more effectively. So that's the newsletter, and thank you for letting me talk about it.
Thank you for coming on. Definitely our pleasure. And everyone in here who heard your explanation of GoodRx earlier, and everyone who's going to go back and listen to it will definitely want to hear and read more stuff from that Substack. So definitely great to have that in there. One more time, appreciate you for joining in, Brad. Make sure you check Brad out and all our other speakers. But with that, I'll keep us rolling and throw it over to Stock Talk.
Yeah, I mean, I think, most of the points I made earlier were relatively similar to the closing points I would make. Just be willing to play the downside while it's here. It's not that complicated. And when you see reversals in all of these individual stocks, when you see them start to retake key moving averages, the charts build back up, they start to get momentum, you see liquidity start to come back in, you see volume start to come back in these sectors, then start adding to your longs again. Because, yeah, might you miss the first 5, 10, 15% move from the bottom? Definitely. But is it worth missing that move as opposed to trying to catch a falling knife? Yes, it consistently is. Mathematically, it is. Because trying to predict when these stocks are going to bottom and buying in level after level after level again and averaging down, you're just building your bag up until that point where, eventually they finally reverse. And if you catch that, you catch that. But if you don't, you don't. So, I've said this pretty much in every space. Be one entry too late rather than 5 entries too early. And this is the perfect market to justify that because of all the people that have been buying the dip on their long-term positions for months and have gone buried because of it. So play the downside while it's here. And then once you see a convincing reversal in the direction of these individual names, then consider your long positions again. Don't just aimlessly and indefinitely buy the dip because it's a good way to blow up your account and get slaughtered in the long run.
Appreciate that, Stock Talk. Always an amazing speaker. Love having you on here. Can you tell us a little bit about your Discord group?
Yeah, man, my Discord group is just, additional education, mentorship, trading alerts from myself and a variety of other, professional and non-professional traders. And, just really a place to try to learn and get better. Whether you're an investor or a trader, there's content for everybody on there. Educational resources. We have Q&A pretty much 24/7. Anytime anybody has a question about anything, whether it's fundamentals or technicals or, just general, support related questions. We have a pretty good community there. It's very positive, no, name calling and bullying and negative sentiment. Everybody's just there trying to make money and get better. So yeah, if you're interested in it, the link's in my bio. If you do want to join, I encourage you to wait till February 1st because Patreon charges the first of every month. It's priced pretty affordably. I think it's just $20 a month. If somebody does, need more of my time or of just general support from traders that know what they're doing. It's a good resource for that. So yeah, thanks for letting me talk about that, Evan. But yeah, if you are interested, the link's in my bio. But again, I would encourage you not to join until February 1st so you don't get charged twice. But yeah, that's just what it is in a nutshell.
Appreciate that, dude. Definitely a great community there. And although a lot of you guys might be long-term investors in here, it's if you're a trader or, you can still get the value out of it from a long-term investor. I definitely do check that Discord a lot. Good thing to be in there. And, paying extra is totally not for everyone. There's endless amounts of fantastic information on Twitter that you can get for free before that person who knows Stock Talk Weekly as the expert that he is and all the quality that gets out of him and wants that little more extra one-on-one or one-on group time with him is definitely a good thing to check into. That, once again, is in Stock Talk Weekly's bio. Appreciate that. And with that, I'm going to keep us going, throw it over to Joey. Joey, if you also wanted to add in a little bit there, more about your thoughts on long-term investing, anything you want to go in there, totally not necessary, but would very, very much love to hear any thoughts you have.
Awesome, man. Yeah, that sounds great. So just a bit of background. I am a long-term investor. Around 90% of my money is in a variety of ETFs, and I have not touched any of those during this downturn here, and I do not plan to touch those for decades. So that money I'm planning to hold for a very long time. So, a tough handful of months or a tough year is not a problem at all for me. With that said, I do have around 10% of my money in around a dozen stocks that I am bullish on for the next few years. And a lot of those names are higher growth names. So if you think FANG and a couple other tech stocks and things like that, that's mostly where that 10% of my money is allocated. So to Stock Talk's point, which I think is a really important one, about being able to play the downside, and even if you are a long-term investor trying to learn a bit more about some of the strategies that traders use, that is something that I have done over the past handful of months, and it's been very beneficial for me. So up until that point, I've really been just 100% long-term investor, right? So in the past, if this kind of downturn had happened, I'd say, all right, I don't really care. I'm in it for the long haul. I'm not going to do anything. But now, with some of the information that I've learned by honestly mostly being on some of these spaces and just doing some research myself, I feel a lot more confident being able to play the downside, selling calls and things like that. So again, most of my money is staying in those ETFs and I'm not touching. I'm holding those for a very long time. But given the current market conditions, again, the Stock Talk's point, I feel like I didn't want to do myself a disservice by not learning how to play the downside and some of the other strategies he touched on. So that's currently where I'm at now. So definitely been a, very valuable learning experience as far as, some of those strategies that typically traders would employ. And it's definitely helped out my kind of trading account there, if you will. So that's been a great experience. And then just lastly, just shout out to all the great speakers up here. Everyone here, you clearly are a long-term investor, and I'm sure you've enjoyed what the speakers have said. So do yourself a favor, check them out. It'll really improve your timeline. A ton of great information from them. So thank you for having me up here.
Appreciate you joining in, Joey. Big shout out to Joey. He helps a lot behind with the Wolf account. Great guy. Definitely been helping a lot with these spaces. Check him out, doing some cool things there. Thank you, Joey, again. And Wolf, I know you kind of gave us a little bit of a wrap up earlier, but if you had anything else you wanted to add in there or whatever, would love to hear it.
Yeah, the main thing I want to touch on is that this is just the first of 4 spaces that we are doing today. So we're going to have a very full schedule and would love to have everybody tune in. If you go to my profile, I already put out a reminder tweet for 2 p.m. in 22 minutes. We're going to be doing investing in oil, gas, and energy industry. So there is a lot that is going on there. We're going to talk about the overall indices as a whole, as well as individual stocks within there that we may like. There's a lot of really good setups if you're looking at things like XOM and a bunch of others that are kind of weighted within there. It's had a lot of times where it's not simply correlated with growth stocks. So if you're looking for a hedge or exposure elsewhere, this could be a great area to learn about. Speakers on that, we're going to have the same co-host, so Stock Market News, Stock Talk Weekly. And then we'll have Matt from Traders Paradise, Gavin, Special Sits, Jay, Juicy will be on there, and then SoFlo, who kind of was the one who reached out and had the initial idea and is going to lead off that topic. So you can be looking for that at 2. At 4 p.m., we're going to talk about investing in IPOs and SPACs, whether that is a good decision for you, whether it's something you should be looking at. There's exciting companies that are going to be IPOing this year, such as Discord and Reddit and Ascensus and Instacart. But should you be investing in those? Should you wait for price history? We will discuss. And then at 7 p.m. EST, I'll have a massive Twitter space covering NFTs and highlighting top projects. We're going to have the She Survives project hosting that is raising money for the American Cancer Society, as well as the Wall Street Bulls will be on there from the Wall Street Memes, and then a bunch of projects and speakers in the audience. NFTs Anonymous, Keith K.O. Kid, Peter Tuchman, and more. So be on the lookout for that. Full schedule for today, and we're excited to see you all on them.
Yes, sir. Full schedule. Exactly what I love to see. And, we just went through, 15 minutes of wrap-ups. If you're chilling in the spaces, still you are, well, there's a small chance you're asleep. Always possible. I'm going to say that's not the majority of the people down there, but you are clearly a big fan of spaces, getting this free content, free valuable content, and not just stuff being thrown at you. So we love to give it. We're excited to be able to do this all day. Today, we're going to be live for 4 or 5 more hours at least. Make sure you're checking that out, following all the speakers up here. You are going to see that. I personally, my name is Evan. I'm the guy behind the Stock Market News account. A lot of people think it's a whole team back there. Nah, it's just me. Just me doing that. I'm doing a lot of stuff on this Rippers. So doing some fantastic things. Make sure you are following the Rippers account, the Green Raccoon up here. I personally put out every single tweet from that account, grinding as hard as I can. Wolf Financial, the guy who was just speaking there, the king of spaces, we'll say, puts in work on the account as well, hosts a bunch of spaces. He's doing 2 a week from here. I'm doing at least 1 or 2 a week as well. So pretty much a lot of amazing content coming for you all in the future. Make sure you're checking out all the speakers that we had up on this spaces here. We'll see you in about 20 minutes for that investing in oil and gas space.